What's up, guys? Alibaba reported earnings today, and so let's dive into it and see what changed and what's the same. You're watching More Money? Let's get it. What's up, guys, and welcome back to the channel, and let's dive right into it. So every morning when I wake up, or at least not when I wake up, but when the market is open, what I do is I'll jump into my tracker, and this is actually something I use for myself, but I make it available to everyone else. So this is just kind of like my screen that I've built myself. A lot of you guys are familiar with it. I've shaded out many of the names, but there were some names that I was interested in today, and I'll build some videos on them. The first one is, of course, Alibaba. I also wanted to show Abercrombie & Fitch, which I'll build something else on. It's a name that we did see the potential for it to run significantly a while ago. And so like this is a win that a lot of people took. And then Build-A-Bear, this one is very funny because I think this is the best performing stock in the S&P for like the last 5 years or so. I can't remember. It might not be, but it's definitely up there. We saw this a while ago. Now, some of us invested in it, some of us did not. I did not, but we did see it really cheap. But what I want to show with this is that this is a pretty good view of the market relative to the intrinsic value calculations, because like I can, everything is kind of sorted by share price as a percentage of intrinsic value, but then you can see a whole bunch of other things right here on the tracker, which is like the qualitative, where has this security gone over the last week, month, and year. So for example, Alibaba, it was down 2.3% today. However, in the last week, it's down 1.7. In the last month, it's down 12.5, and in the last year, it's up 83.5%, which in the last year, it actually probably is one of the better performers. Yeah, it definitely is on this list. And so this is just an overall view of the tracker. And so shameless plug, if you do want to get access to the tracker, it's $5 a month. If you don't like it, I'll give you a complete refund back, but try it out if you're interested. And the link for the tracker is in the description below or the first pinned comment. But diving right into Alibaba's results, this is the slide that I like to go into first because it kind of just shows everything. And so overall, you can see revenues up 5%. Well, part of the reason why revenue is up only 5% is because you got a year-over-year decline because of the sale of or the disposal of SunArt. So that's what's impacting the revenue. I would love to see this apples to apples, but it is what it is. As a finance executive, I would want to look at this apples to apples, and so I'd probably provide a non-GAAP view. But that be it as it may, the interesting thing and a good thing that I saw was that the Alibaba e-commerce group is up 16%. However, when you dive into it, you see that the only reason why it's up 16% is because they're sacrificing profitability for revenue. And so the customer management group is what you really want to focus in on. It's still only increasing at 10%. And this is what I mean. And of course, and let me, before I hop, notice that cloud, it continues to accelerate, and it's accelerating while not sacrificing profitability. And so that's a really good thing. Good to see overall. And then of course, international, I'm okay with 10% on international. So let's jump into the e-commerce section first. So you can see that they did accelerate the onboarding of brands into the quick commerce revenue stream. They call it Taobao Instant Commerce. So it did increase 60%. However, look at what's happening down here. Profitability is declining materially. It is adjusted EBITDA for the quarter is down 76%. And I think this is what the market is picking up on and why the shares are declining. Profitability is collapsing as they are investing into the quick commerce business. And so, they're betting that as they onboard many of these brands, eventually their take rates will increase, which is what's been happening for the e-commerce business, or sorry, the customer management business, because you can see that the 10% year-over-year increase has not been due to the increase in number of customers. It's really due to the increase in the take rate. And so they're betting that they'll establish this, and then of course the take rate will improve over time. And so we will see what happens, but we are now in a territory where if the profitability of this segment is declining by 76% and they're investing into the cloud business as well, this company is now a cash burning company. So pay attention. Now with cloud, you can see that they continue to accelerate adoption in their AI products across a broad range of customers, which is great. I just think that they have picked up on the global trend. I mean, I myself, just to be completely transparent, there's nothing that I do in my workflow that doesn't use AI now. I am I would say interacting with AI 80% of the time when even I work, and I'm just in the finance space. So imagine people in the tech side. And so they are absolutely positioned and future focused here. And so this is why the adoption is happening. Everybody, you're either being dragged into it or you're leading the space. I would say I'm kind of somewhere in the middle. And the good thing is that they're growing their cloud business while not sacrificing profitability. And so they remain at around 9% despite growing a revenue by 30%. And this is what I mean about the free cash flow declining. Part of it is because of the fact that they're investing into the Taobao quick service app. And then the other piece is because they're investing into the cloud business. And so it is what it is. This is what the business is now. So jumping into the live model tracker for Alibaba, you can see somebody's in it right now. This is again what you get access to, and you click back here and you can go to the tracker that I showed you originally. But this is the Alibaba model, and you can see it's pretty detailed. And I got some nice pictures here. But like you scroll down, and you can see, and this might be hard to see, so I'll just give you the audio over it. But you can see that in terms of the share price valuation, I still think that this company is worth around $160 per share. Current share price roughly reflects that. So I think it's trading at approximately what it should be worth. And of course, you guys may have a different valuation. I know in the comments there's some people who believe that this thing is worth $250. I absolutely do believe that if they pick up on the revenue growth for the China commerce business, if that thing goes into the 20% and the profitability significantly increases, yeah, you can see this business at $250 per share. I'm just not giving them the blue ocean treatment in terms of the valuation. I'm being, I would say, somewhat conservative, but I can absolutely see people's valuation models being in the 2s to 250s. And so you're not wrong. You're just being less conservative than I am, and that's totally fine. Or you just might understand the business better than I do. I would say I'm a bit of a simpleton generally when it comes to many of the stocks that I follow, and so I tend to be a little bit more on the conservative side. But let me know what you guys think. Let me know in the comments below, and I'll respond to everybody. And so I hope you liked my overall overview of where the quarter went. It's much of the same as to what we saw last quarter, which is why the market didn't really react. But again, if you see profitability increase significantly, this thing could really rally. And so I'll leave it there. Let me know what you guys think, and I'll see you guys later.